All right, everybody that doesn't know who I am, I'm a securities attorney and chief legal officer at Tribevest, and great to meet everyone. Continue the chat throughout. As questions come up, just drop them in there. We'll get to them at the end of the presentation. And yeah, and if they're relevant right at the moment, maybe we'll answer them there on the spot. But don't be afraid to ask questions. Even if it's a private question you want answered, send it to one of us at Tribevest here, and we'll answer it after the show here. So, whether you've been doing this for years or you just started to think about how to launch or scale your capital raising business, you're in the right room. The next 45 minutes are going to change how you really think about raising capital and where it can really take you. Especially for those of you that that already have been in the space for a little while and maybe have done a co-GP deal, or maybe you've launched a fund and maybe didn't go as well as you thought, or maybe it was more complex than you thought, or maybe you didn't make as much money as you thought you'd make. We're going to walk you exactly how to build it our way. After tons and tons of experience in the industry, we've just seen what's worked and what hasn't. And then at the end, we'll have well, it's not really at the end, probably about halfway through, we're going to have a special announcement that's going to really land for a lot of you and should be an awesome offer for you guys to get going on scaling your capital raising business. So let's get it going. Quick disclaimer, legal housekeeping. I'm an attorney, but I'm not your attorney. And today I'm just here in an educational capacity. Also, Tribevest is not, it's not a law firm. We're not a broker dealer or an investment advisor or CPA or anything like that. We're a financial tech company. And so do your own due diligence on compliance and laws and taxes and investments and sponsors because we'll be talking about deal sponsors, but you got to do your own due diligence. And we're just here to help you along your journey. So let's keep it going. All right, so let's take a look at this list. And, if you're paying attention out there, maybe do something for me. If you've done a co-GP deal, type co-GP in the chat. I know a lot of us have. I'd be typing that in mine. I've done a number of co-GP deals in the past, over the past decade or so. Go ahead and type co-GP in the chat if you've done a co-GP deal or you're currently doing one or you expect to do one soon. If you have a strong network of investors, but you're not sure how to launch or scale your capital raising business, type network in the chat. There's many folks out there that are high performing W-2s. Maybe you're a doctor or a dentist or an engineer or a lawyer like myself. And you know a lot of other people that are in similar positions as yourself. So you already have a great built-in network. If you have that network, type network in the chat. And next down the line, if you're doing a little initial research on how to raise capital or what a fund of fund is, and you're unsure of what the next steps are, type in research in the chat so we know that you're just kind of getting started and you want more information about it. And if you want to get paid for bringing capital without being involved in the operations and the asset management, and this really hits home for myself because I got involved on both sides of the table where I was raising capital, but also on other deals where I was the operational partner and managing assets. And I quickly learned that managing the assets, managing large multifamily properties, RV parks, all those sorts of things, didn't really love it. It's a ton of work. Not that capital raising isn't a ton of work either, but it's a different beast, and sometimes it's not for you. And maybe you really want to focus on raising capital. So if you're trying to raise capital, figure out how to get paid, and you don't want to do the operational side or the asset management, type in capital in the chat. And then if you're ready to stop doing one-off deals and build a real fund manager business, one that's repeatable, compliant, professional, capital raising machine, and you're ready to scale, type scale in the chat. If any of those things sound relevant to you, even if you didn't type anything in the chat, this is going to be for you. So here's the plan for the show today. First, why the co-GP model is broken and compliance gap. Most capital raisers don't even know they have. Second, what is the fund-to-fund structure? What it is, why it works, why it's the right answer for almost everybody in this room, whether you're a lead sponsor or that operational partner, or you're a capital raiser, you've done the co-GP model in the past, you're ready to scale your business, it applies in one way or another. Third, the system itself, the step by step, from finding a deal to getting paid, the exact playbook. We'll go through that. And then again, the special announcement, which is actually about halfway through, because we really want to dive deep on that, because we're launching something really special and really specifically for the people on this call. And then last but not least, the path, how you go from zero to a live deal page where you're accepting your first soft commitments in under 6 weeks. And that's a promise. If you stick with me, take notes, ask questions in the chat, we'll get this thing going. Real quick bio on me. Again, securities attorney, worked in big law at a top global firm. So I got my training there. I'm also an active fund manager and syndicator by practice. Still have about 90 million in assets under management. So I do this on both sides. I've personally architected over 750 funds. It's probably more than that at this point. I've helped guide more than $3 billion in aggregated capital across 9 billion in total deal transactions through that work. I've helped build the compliance framework and the fund-to-fund product at Tribevest. So this is my baby, and I'm here to get you guys excited about it. So when I tell you what works and what doesn't, it's not just from reading from a textbook or watching YouTube videos or some course that a marketer put together. It's what I do every single day with hundreds of capital raisers in real time with the SEC and state commissioners watching everything that I do. And I've seen how people scale to 7, 8, even 9 figures, and have seen what gets people sued and what gets people over the hump to success. I don't want to scare you away. I know there are some attorneys out there that'll scare you. I'm not here to do that, but you can get yourself into trouble if you're not paying attention to the guardrails and what you're supposed to do and what you're not supposed to do. So we're going to talk about both of those today. All right, look at this graph. This is really exciting. And I've got a whole presentation on this as well, just talking about how private capital is exploding and going to explode. I know it feels a little bit slow right now because commercial real estate is a little bit slow, but it's odd because yes, deal transactions have slowed down in the last few years, and we're waiting for that next real estate cycle to spin up and start accelerating. But at the same time, there is so much private capital and pent up demand waiting for these deals. They're just waiting for these deals. And why this conversation matters right now, it's because there's over $12 trillion in alternative AUM globally, 3.2 million in private real estate alone, and over 72% of high net worth investors, which most of you are going to be raising capital from, are adding these alternatives to their portfolios, and many more on top of that want to get involved in the game. And that's a massive tidal wave of capital, creating one of the biggest opportunities for capital raisers in the last 20 years. You can see the prediction of how much private capital there's going to be out there in the markets as people, even though the public markets are doing really well, people still want exposure to diversity and to alternative investments and to real estate because the information and the opportunities are just out there nowadays. So you're seeing family offices looking for fund managers to run smaller checks alongside of them. You're seeing RIAs getting demand and requests from their clients for alternative exposure. Doctors, professionals, business owners, they're tired of just the stock market and how it goes up and down and how it's really highly dependent on AI right now. And they're looking for someone they trust to put into real assets so they can get diversity in their exposure. And the question is not whether the capital is moving. The question is whether you have the motivation, the grit, and the structure to capture it. And there are going to be so many people out there who are going to build generational businesses out of this window in time. And there's also going to be people that will watch it happen and regret it later. All right, let's start first with the problem. And that's why the co-GP model is broken. And some of this might apply to you guys and some of it might not because you're just getting started. So you weren't really part of that co-GP wave. But it was a problem and still is a problem. For years, co-GP was the default play for capital raisers. Again, quick poll, pop a yes in the chat if you've ever been a co-GP on a deal or you're thinking about being a co-GP in the deal. Give us a good idea of what experience you guys have had. And you just run into a lot of issues there. On paper, it looks great. You bring the investors, the sponsor brings the deal, you split the GP economics, everyone goes home happy. Sounds clean. But the problem is, in practical terms, and what actually happens, the legal reality is just, it's very different. A real co-GP, and I don't even like the term co-GP. You're either a general partner, a GP, or you're not. There's no like GP and then co-GP. You're a GP or you're not. And a real GP is actively involved in the management and the operations of the deal. And they're making decisions on the asset. They have voting or managerial rights. They're signing on the loan. They're sitting in all the meetings and making decisions about leasing and operations and asset management. They're taking risks, they're making decisions. Those are the things that you do. But what has happened is people have joined these and called themselves these entities, these funds or syndications, and called themselves co-GPs. And really, their primary contribution and really their only contribution is raising capital. And you're calling yourself a co-GP just to justify that you can compliantly raise capital for the deal, but it's not a legitimate arrangement. Just because you call yourself that doesn't mean you're actually doing it. And what you're actually doing is you're acting as an unregistered broker dealer. So that's having your Series 7, your Series 65, just like you think of it, like a stockbroker. Those are the people that are allowed to raise capital and get paid a commission for it or even get paid equity for it. They're allowed to do that because they're licensed, just like I'm licensed to be an attorney to practice law or a doctor is licensed to practice medicine. You have to be licensed to raise capital, and that's a broker dealer. And most people are not, and most people don't want to be and should not be because there's just so much regulation and compliance that goes along with that. So you have to find an exemption to be able to do that. And if you are an active partner in your own deal, that's called what we like to call the issuer exemption because you're the issuer of your own securities of your own deal. And the SEC has been very clear about this over the years, but over the last few years, it got abused, and they've gotten more aggressive about enforcing it. It kind of comes and goes in waves. I think right now it actually has kind of subsided a little bit just with the current administration, but it will certainly come back. And then people that abuse it are going to get caught anyway. So, people think that they're being clever with different documentation and trying to manage it, but at the end of the day, if they really want to go in and find out if you're getting paid based on how much you raise, you're getting equity based on how much you raise, and all you're really doing is raising capital, they're going to figure it out. They're smart people. They're going to find out that you're raising capital without a license, and you're going to get in trouble. You probably, unless it's fraudulent or it goes to that level, I'm not going to scare you and say you're going to go to jail, but you might not be allowed to raise capital for a significant period of time. You might have to pay all your investors back plus interest, and it can be a financial nightmare for you and probably be the end of your capital raising business. So, I've had calls with capital raisers who came to me after the fact and said, like, how do we fix this? I realize now that I shouldn't have been doing this. And, it's tough to say what you can do. You can try to clean it up by unwinding all the investments and give the capital back. And even then, you're really asking for forgiveness. But it's just a really hard conversation to have. So if that's you right now thinking about going into a co-GP deal, you really need to talk to a securities attorney, make sure that you're really an active partner in the deal, not just raising capital, and that you're compliant. And if you're not, then you need to find another way to bring your investors that deal, which we'll get into next, which is the fund to fund route. And that's the clean way to do exactly what you want to do, which is being fully compliant, raising capital, and managing your relationships without actually operating or being an active operator of a property or something like that. So, and here's the other half of the pain. Not only is co-GP non-compliant, well, great, but if you do something else, you've got all these things you've got to handle, right? If you're a co-GP, the lead sponsor is handling all this stuff for you. All these things that are they're listed here, the co-GP really handles this for you. If you haven't done one of these deals, you'll see that the lead sponsor, the person actually operating, is going to handle all this stuff for you. So that's a problem because if you say, okay, well, I'm not going to do it non-compliantly, I'm going to do a fund to fund. Well, you've got to figure out how to do all the stuff yourself. It's an assembly problem. You've got to assemble all the pieces to build a compliant capital raising business. And they're out there, but you just have to start piecing it together. And some of you folks have already tried to do that and found that it gets expensive, it's time consuming, and you're not sure if you've got all the pieces together or not yet. And you need a securities attorney, right? You need somebody that knows fund mechanics, not a generalist. A lot of people get themselves into trouble with that. Most attorneys don't know this stuff because we're just like doctors, right? Like we are specialists, and the people that say they're generalists can't talk about neuroscience or your brain or your heart, right? You can only speak generally. You need someone that's a specialist, so you need a securities attorney. And because they're specialists, they're expensive. So they're charging $15,000 to $25,000 or more for a single fund formation, even for a simple SPV. And the ones that don't know how to structure it, and they'll probably charge less, but they might get you into trouble down the line. You need a CPA. Similarly, you need a CPA who understands fund tax structure. Most of them don't. So you need to make sure that they understand how the economics work and how the taxes work within a fund structure. You need offering documents from that securities attorney, PPM, operating agreement, subscription agreement. Each one has to be tailored to your specific deal and your specific offering. You need an investor portal. Of course, you've heard about a lot of them that are out there. So your LPs can feel that you are professional, that they can actually see their position and their investment, and can track your deal and communications and their capital. You need to open up a business banking account, get an EIN, set up your LLC, all those things that go along with starting a business. And it's not as simple as opening up a personal bank account if you haven't done it already. You have to have a bank that's willing to that understands a fund structure, and that there's going to be passive investors and are willing to take that on, because there's going to be a lot of money coming and going, but not a lot of money sitting inside of it. So they don't love that. You're also going to need deal flow. You need to cold pitch investors and sponsors. You need, as a brand new fund manager with no track record, very hard to do. And every single one of these is a separate vendor, a separate contract, a relationship to manage. And you're the project manager, keeping it all in line and all coordinated. So by the time you're done putting this all together, you've probably spent $25,000, $30,000 and many months in your life, 4 to 6 months. A lot of us get stuck on this, and maybe we never even move forward. So why the fund of fund structure works better? Um, and it's always been the answer to a broken co-GP structure. But again, all those problems that we just talked about have gotten in the way. Like, those are the problems we have to overcome. And until recently, we haven't been able to fix that assembly problem. So I just want to show you real quick what the fund of fund structure looks like. Picture a syndication or a deal over on the left side there. The general partners run the deal. They're the operators. They're the lead sponsors. They're signing the loan. They're buying the asset. They're actively managing it. Then you've got these limited partners, or the passive investors that invest maybe directly with them. And that's the standard model. They write checks straight into the deal. If you're a co-GP, so to speak, you're going to take your investors and they're going to invest directly with you and the other lead sponsors in the deal. And you can see where that can cause a problem for you, because you're going to share that investor information with the lead sponsors that you're working with, who you may or may not know very well, and they're going to start marketing to your investors, and maybe they're going to go around you on the next deal. That's happened to me on a couple of different deals. It didn't have malintent, but it happens. It happens. So now picture this kind of invisible wall you see there in the middle. And that invisible wall really represents the relationship between you and your network of passive investors. And that's the invisible wall for the lead sponsors as well, because they want to access your investor capital, but maybe they don't have those relationships that you have. And that invisible wall is something that you actually can own as the fund manager. You're the key to break through it. You have access and trust to your own personal network. Investors come into your own fund, and then your fund aggregates that capital and invests as a single limited partner into that syndication that you see there on the left. And that's it. That's the whole structure. You become a single limited partner in someone else's deal, but inside of your own fund, you're actually the general partner. And you're not in the operations of the underlying deal. You're not making decisions about the asset. You're not managing, or sorry, you are managing your own fund, your own relationships, your own investors, and you can protect those identities from the lead sponsors as well. Um, you handle your own reporting and communications and distributions, and the asset level work is really the lead sponsor's job, whereas the capital level work is yours. And that separation is really what makes it safe for everyone and makes it more compliant across the board. And it makes it scalable again for you because you're able to protect your most important thing in your capital raising business, which is your investors. They're the most important thing. You want to treat them with respect. You want to keep them, you want to build those relationships and keep those relationships with you and not necessarily share them with everyone else because then they might invest with other people. You really want to control those relationships and build your business based on that. And this structure is repeatable. It's not new. It's institutional money has used this structure for decades. Endowments do it, pensions do it. The largest LPs in the world allocate funds through a fund to fund structure. So it's proven, it's safe. It's what professional capital raisers use. It's just, again, it's been really complicated and expensive to use. So if you're raising a smaller amount, it's really difficult to make that work. But it's what institutional players have been using for a really long time. So a quick side-by-side comparison here of the co-GP versus fund funds. 5 categories. SEC compliance, co-GP risk is high for all those reasons that we talked about. Fund of funds is compliant. It's clean filings for each new SPV. It's scalable. Co-GP is really difficult to scale, and for those of you that have the experience, you know why. It's because it's hard to it's difficult to manage your investors and keep them away from your lead sponsored partners. They're all in different portals and it's all spread out across different technologies and platforms, and it's just really hard. You're going deal by deal. Every deal is a new negotiation, a new structure, a new set of documents. And on the other side, fund of funds is just a repeatable system. Once you build it, you run the play over and over again. The investor experience, co-GP is inconsistent. Your investors, again, they just get a different experience with every deal. There's different documents. There's different documents, different portals, different distributions, mechanics. They don't feel like they're dealing with a real fund manager or professional capital raiser because the experience is just not consistent. It's like the McDonald's hamburger, right? Like it's consistent. You don't necessarily have to be the best, but you've got to be professional. You've got to be consistent time and time again. And with the co-GP model, that is really, really difficult to do. Um, your economics, co-GP is a lot of times undefined and hard to figure out exactly what you're going to get paid. I know when I was a co-GP on a few deals, it was just really difficult. You put a lot of trust with the lead sponsor that they're going to pay out what they say they're going to, that the economics are going to work out like they're supposed to. They're not going to change their deal. It's really opaque. So, and on top of that, you're just negotiating from scratch every single time. So the fund of funds, on the other hand, it gives you a way to structure your own deal. You can decide how you get paid and how much you get paid and what's fair to your investors. And it gives you really, and we'll go through it, 3 clear fee layers that we're going to walk through. Excuse me, I got something caught in my throat. Operational burden, co-GP, you're dragged into the back end of the deal. You by definition, you're doing a lot of the operational detail, answering operational questions, things that you probably shouldn't be answering because if you're not the operational partner, you probably don't even know. Whereas with the fund of funds, you only raise capital, you're really deferring to the expertise and the operational partner, and the operator really handles the asset, and they can help you answer the questions that are directly tied to that. So there's really no comparison once you actually look at the model side by side, and feel free to ask any questions on that. So this is a case study. We usually don't say Dylan's name by name, but we've got him here. We're gonna end up having him become part of the special surprise. So let me tell you about Dr. Dylan Reach. He's an optometrist by trade, longtime passive investor, my friend and client. He's been investing in syndications and funds for years, but he has a great network. His patients trust him. His friends ask him about the deals that he's investing in, and how he's able to get exposure to these types of deals. He was constantly bringing people into some of those deals informally, doing introductions, and then he was like, well, he's a really good businessman as well. So he's thinking like, how do I actually get paid for this and not get in trouble, right? How to do it compliantly. Because he's been leaving money on the table by making those introductions every time to these lead sponsors. So we met, we set up a fund of funds with Tribevest, 5 business days to launch, and he closed his first deal almost immediately. I mean, Dylan is amazing, but he closed it really quickly. 633K raise on 7 investors, made about $8,000 in an upfront fee on day one, and that alone paid for his fund setup. Just that alone. Um, which, by the way, the fund setup is actually an expense of the fund, so you don't have to pay it out of pocket or you get reimbursed later. But here's what's really important. He didn't stop, right? It wasn't just one. Like that's great that he did that one deal and made $8,000. Okay, well that's not life-changing money. And that's just the upfront fee, by the way. He'll make more than that in the back end. But he just kept going and kept stacking and kept building. And he had a land acquisition that we talked about. Then he had 2.1 million dollar raise from a paving company, a paving fund, where he made about a 30K upfront fee. He did another multifamily deal where he raised about 1.2 million at $52,000 in upfront fee, and each one got easier than the last because it's just like anything else. You get reps, you do the same thing over and over again. It gets smoother, and you get better talking to investors and pitching investors. And especially when the infrastructure, such as Tribevest, is in place for you and handles all this operational or administrative tasks, then you can focus on the relationships, which really allows you to scale. And today, 14 deals, and I don't even know if this is totally up to date, but 14 deals, 176 passive investors, $34 million raised. And what that equates to, and this is in about a 2-year period, by the way, this is not very long at all, maybe less than that, roughly $3.4 million in estimated revenue that he will be collecting as the fund manager from that work. That's crazy. $3.4 million from his capital raising business, that he's kind of doing on the side with other stuff and traveling. I know Dylan travels all over the world. He's doing this from everywhere and spending time with his family. And he's still able to generate $3.4 million in revenue over the last not even 2 years. So same network, same relationships, same conversations he was already having before. But the only thing that changed was he put a vehicle behind it and he started running a real fund manager business. And the wild thing is his investors love him for it. He's really generating real relationships with these people, and they get better terms, better reporting, a real portal, all the above. I need to pick it up. I can see, but Dylan's not a one-off. We're the platform behind it. Tribevest, we've supported over $150 million in capital raised, 200 plus funds launched, 150 ICAs, we call them independent capital aggregators, otherwise known as fund managers. And the average fund formation time, 5 business days. Compare that to 4 to 8 weeks or even longer to launch with a securities attorney and coordinating all those different vendors that we talked about. And the proof is everywhere. There's a couple of great quotes from a couple of our sponsored partners. So this is really what it looks like to operate at scale, in production with real fund managers running real funds, and getting paid real money. And that's the foundation we're building with this accelerator that we'll be talking about soon. And we can help you launch really, really quickly. And let's run through this really quickly, just so you understand the structure and what all goes into this fund setup. So 5 steps: finding a deal sponsor, setting up with Tribevest, raising capital, onboarding your investors, and getting paid. That's it. That's the whole game, simplified. And we'll walk through each one here really quickly to give you some practical detail on each one. And by the end, you're going to have a blueprint of what it takes to operate a fund of funds. Find step number one: find a deal or a sponsor. Two paths. One, you find your own deal. You bring your own deal, your own sponsor. You already have maybe a working relationship with an operator, or you're in a mastermind. You've done past deals, or you have a sponsor relationship from years of being in the space. You bring that deal directly to Tribevest and you build your fund of funds around it. You own the relationship, you choose the deal, Tribevest handles all the infrastructure and building your fund of funds. Option B, you access deals through our network. This is fairly new for us, but we have, over the years, we have many institutional quality lead sponsors in our network, dozens and dozens of operators across asset classes who collectively have raised billions of dollars, multifamily, oil and gas, mobile home parks, self-storage, private debt, build to rent, you name it, we've done it. And we have sponsor partners that have done it and done it at a very high level. So if you don't know which operator or which asset type that you want to work with yet, or you want to get exposure to, um, and you want to expand beyond the one or two relationships that you already have, you walk in, you see their live deals, and we can introduce you, and you can pick the ones that fit yourself and your investor base. And again, these aren't random people. These are professional sponsors with track records that you can do your due diligence on and verify their track record. And we help you curate that. So whether you have a deal already or need one, both paths are open to you. Step number two, set up your fund of funds with Tribevest. Again, 5 business days, everything done with you. We'll walk through all the different things that are involved, because this gets confusing because some people think that we're just an investor portal or we're just a securities law firm substitute where we just do your offering documents, but we're more than that. We are all inclusive. We form your LLC, registered agent attached, automated annual report filing built in, KYC, AML checks, all your offering documents, your PPM, your operating agreement, your subscription agreement, all templated and ready to roll. Accreditation, verification, 506C handled automatically, 506B through self-attestation, federal D, so your federal Form D filing. So we handle that for you, which a securities attorney might normally handle, both your 506B and 506C. Investor portal, where every LP sees their position, their documents, their distributions, their K1s, all on one branded dashboard. So we do include an investor portal, which has been recently revamped. It's beautiful. Business banking and EIN. So we set up your business banking account, get your EIN, and we do your digital document signing for a full audit trail. All your blue sky filings handled at the state level, which are a real pain. I'll tell you that from my perspective. We do your cap table management, help you set that up and make sure that everybody's getting the proper distributions and equity that they're supposed to, and also your K1s. So we handle your fund administration and your K1s in the background on an annual basis, so you don't have to worry about finding a CPA that knows and understands fund of funds. So if you assemble that yourself, that's at least 6 different vendors, lots of hours of project management, and probably 15, at least 15, closer to $25,000 to put it all together. But Tribevest does it in 5 days and for $5,000. It's a no-brainer. So, here's the comparison: the old way, again, probably $25,000 versus the new way of 5. The time to start up, again, we can do it in 5 business days. Management, lots of time to put this together, figure it out, to quarterback your deal compared to us doing it with you and putting all the pieces together for you. Back office compliance administration. Again, fund administration in the past used to cost a lot of money. You would have to raise probably, I would tell my clients, $5 million, maybe even a little bit more than that, before any kind of fund administrator would make sense financially. But with Tribevest, we do the fund administration, and we do it in such a cost-effective way that you can raise as little as $500,000, and it really starts to make sense. So that's where that minimum raise to make the economics work is really important, because it's really hard to raise $5 million. It's a lot easier to raise $500,000 because you can probably aggregate that with the people that you already know and that trust you and are in your current network. So it makes a huge difference, and you can start stacking those $500,000 to $2 million raises over and over again and really build a business like you saw the example from Dylan. All right, now you raise four moves, set up your funding deadline with your sponsor, set up your branded deal page. It'll have a soft commitment funnel. And I really want to stop on this one because we'll be doing this in the special surprise that we're offering for you because you're going to be able to launch this thing for free. You can launch it for free while you gather your internal commitments, and there's no financial commitment from you to move forward with, let's say, all of our setup documents and filings and things like that. You can launch a deal page, start collecting investor soft commitments, and then decide, hey, well, I'm not getting the soft commitments that I wanted, so I'm not going to move forward. All good. No problem. We'll do the next one. Or you are getting those soft commitments, things are looking great, and you want to move forward, then you hit the go button, and then we spring to action, and we can get you to start turning those soft commitments into hard commitments. The step number three, you can start doing, your investor webinar, your pitching your investors, your phone calls, all those kind of soft skills. And we'll be able to teach you those sorts of things in the accelerator as well, which I'm alluding to because we're coming right up on it. And four, close. We'll coach you on how to move those soft commitments to wired capital, which is sometimes really difficult. Somebody, it's easy to get somebody to say, yeah, sure, I'll invest $50,000. But when they actually have to call their bank and wire that money, it becomes real and is a lot harder to do. So there's a lot of psychology that goes along beside that. Step four, onboard your investors. This is where Tribevest carries the day. All those things that I mentioned that we do, this is where they kick in. Offering documents will go out to your investors through DocuSign automatically. All your investor checks, wire instructions, deadlines, real-time status updates on your dashboard, investor portal access for your LPs branded for your business, cap table consolidated and built for you, distributions to your LPs automatically and within 3 to 5 business days of receiving them from the lead sponsor deal. And again, K1s are also included in the package. So the whole investor life cycle is managed in one place. So you can focus on the relationships, the conversations, finding new investors, and talking to existing ones about the next deal. The platform handles everything else. That's exactly the division of labor that you really want because you want to do the human work, and that's what's valuable. And our platform will do the operational work. Step five, the part everyone wants to talk about. How do you get paid? So, essentially, you've got an upfront fee, you've got an annual fee, and you've got an exit fee. That upfront fee, if you look at the market, you might see 1 to 3% of committed capital. So, on $1 million raise, that looks like $10,000 to $30,000 in your pocket right up front. An annual fee, so this is charged every single year. You might see a 0.5% to 2%. And on $1 million fund, it's $5,000 to $20,000 every single year to kind of keep the lights on. And as you stack those funds, that recurring revenue for you as the fund manager starts adding up. And that's the kind of the cash flow for you. That's where you start being able to, peel back your hours from work or quit your W-2 or things like that and have more free time for yourself by having that cash flow, that assets or that asset management fee. And then third, the exit fee. Sometimes you'll call it a promote or carried interest or a profit share. And you might see 5 to 20% of the profits above that preferred return and is paid at exit. So that's usually your big payday. But a lot of it depends on how successful that deal ends up being at the end. But that's what we're all hoping for is that big payday at the end. So those are three streams, and you can see how those scale when you're doing you raise $2 million across two funds in a single year, which is easy to do. You're pulling out about $40,000 in acquisition fees or more, $20,000 a year in management fees, and you set up two to $400,000 in promote on the back end on the exit, and then you just stack year over year, and you replace your income and set yourself up in the future for a really big payday. So, and that's just for 1 year of work, relatively small fund sizes. You can go much bigger. And imagine if you do that every single year as the funds compound. And that's how you build a business. Yeah. And we'll run through this too quickly and don't get too bogged down on this. But a lot of people ask, like, where these fees come from, who's paying for them. what's the source here? And side by side, you look at a $500,000 direct investor in the syndication deal, so the top level lead sponsor deal, they get standard terms. So let's call it an 8 or they get enhanced returns over, let's say, a $50,000 investor. This doesn't show that, but let's say there's two levels. There's a $50,000 investor and there's a $500,000 investor. That $50,000 investor gets certain terms. The $500,000 investor gets better terms. And you, as the fund or the fund manager, are going to get those better terms. So you maybe get an 8% pref, and let's say you've negotiated a 70-30 split, and that's what your fund to fund is going to get. Now, that money, as you get returns, are going to trickle down into your fund to fund as just a big passive investor. And maybe at your fund to fund, this is where you decide. You get to make decisions on your own fund. Maybe you decide to collect a 2% upfront fee, maybe a 1% annual fee on top. You take that first, and then it trickles down through your own waterfall that you set up. So you decide what pref you want to offer your investors and what split you want to offer. And you might offer them the same 8% pref and maybe a 90-10 split, because it's going to be going through two waterfalls. So it's going to be a much more advantageous split for the investors. But at the end of the day, what this does is your investors still get the same deal as if they invested directly with the lead sponsor, if not better. And nowadays, you can probably negotiate a better deal for them, and you still get paid. But the key is that you get paid based on your investors and from your investors and what they're investing, as opposed to the lead sponsor paying you, which would be the co-GP model that we talked about. So everybody wins. The LPs win because they get better economics than going direct. You win because you get paid in those three ways for organizing the capital. And the sponsor wins because they get a single, clean, professional $500,000 check instead of 10 or 20 smaller checks that they have to manage and administer and put out K1s for. And that's why sponsors they're hungry for this. They love working with fund managers because you make their life easier and they want to reward you for it. Real numbers from a real deal, $500,000 investment into a syndication, 5-year hold, year by year, your fund generates returns. Capital raiser profits over that 5 years come out to roughly, in this deal, $77,000. That's a pretty high return. That's about 15% or so. But we see that. We'll see anywhere from 8 to, we've seen upwards of 20% of the capital raised that you can expect over the five-year deal. That you'll receive in fees over the lifetime of that project. So it can be a very, very lucrative business for you. So you can get a really clean, scalable income stream on the spread, and you can scale quickly. All right. So that brings us to the announcement. And I've said it a bunch of times, it's hard not to talk about it and still talk about the slides that we were talking about earlier, but it's introducing the Institute for Structured Capital. So we're launching the ISC, and it's a 10-week accelerator built specifically for capital raisers who want to do exactly what we just walked through to build a compliant, professional fund of funds business, not someday, but this summer. This summer, within the next 2 months. 4 pillars, 1 attorney-led curriculum. I'm the attorney, of course. 6 weeks of compliance-first instruction, and you're not learning fund management from a marketer. You're learning it from someone who lives in the compliance and lives in the weeds every single day. I'm seeing so many deals across the board. I can tell you what's customary. I can tell you what's typical. I can tell you what's market. 2, you're going to build fund infrastructure. So if you move forward with launching a deal, all those things that we talked about Tribevest doing, that'll be, part of it. But at the very least, there's going to be 2 stages. One where you launch your deal page and start collecting soft commits, right? You've committed to a deal, launch your deal page, start getting soft commitments from your network, and hopefully you generate some really good enthusiasm. And then we'll move to the second stage, which is where Tribevest jumps into action, spins up your infrastructure, and then you can start collecting and aggregating capital, and you'll be well on your way to your first capital raise. 3, institutional deal flow. So we'll have at least 4 live deal presentations from our lead sponsor network during weeks 7 through 10. So at the end of the program, after quote unquote graduation, operators who have already raised billions of dollars presenting their deals directly to you, not cold emailing. You don't have to cold email sponsors after this to start conversations from nothing. You're going to get real relationships. They're going to be built throughout the program because these same sponsors are going to be able to join our educational mastermind calls each and every week to give you real-time market insights and information about what they're seeing out there as well, because they're the ones that are creating all this opportunity. For a curated community, we're looking at about 30 vetted capital raisers in this class, and it'll be a lifetime alumni network, the ICA certification at the end upon graduation, and it's an industry first. So we're creating a credential because the role is real and the market is going to start recognizing it. So it's 10 weeks. The first 6 are really the instructional piece, and then the 4 weeks of deal presentations, 30 seats, ISC accelerator, and starts June 1st. So why we built this and why we're launching now, we watched the same pattern hundreds of times. The information exists, the infrastructure exists, the deal flow exists, but nobody's really assembled this all together. So we're doing it here at Tribevest, and I agreed to lead this as a securities attorney and an active fund manager because I'm not aware of anybody else that's actually playing both sides of this, that's actually growing a securities law firm business as well as an active fund manager and capital raiser. So I architect, and structure hundreds of deals for hundreds of fund managers, and also run my own deals as a capital raiser. So I'm speaking to you from the business side as well as the legal and compliance side, and that's a perspective you'll get for the next 10 weeks. So real quick look at the 10-week curriculum, June 1 kickoff. It'll be based on 7 calls during the curriculum. 2 the first week. One will just be kind of an introductory call. And we're going to introduce you to Dr. Dylan Reach, who is one of our star ICAs, again, who's raised $34 million in the last not even 2 years. And he'll answer questions on how he's had so much success. And perhaps we'll have some other folks on as well that have built had similar success in our platform. And then we'll go through the different major pillars here of what you need to learn and what you need to know. The foundations, the economic engines, how you get paid, how you structure a deal compliantly and successfully for your investors, how you have conversations with investors, how you close and pitch them, kind of those soft skills that you need to have. And then also just the infrastructure and the mechanics behind everything, how you actually practically launch a deal page, and we'll do it on the spot. That's the whole point of this Accelerator One program, is not just to go out and give you some education, some videos to watch, and a course to watch. Like, you can do that anywhere. You can go to YouTube and get this stuff. But what we're going to do is help you build each and every week so that you have the confidence to actually launch your deal page by week 4, and then, or week 4 or week 5, somewhere in there. We need to set this in stone, but week 4 or week 5, we're going to launch a deal page. You're going to start getting soft commits. We're going to help you with the soft skills, help you pitch, and then you're going to graduate. And hopefully that deal that you found kind of throughout the course of the curriculum, you're ready to move forward with. But if not, then we'll have some more deal presentations in weeks 7 through 10 where you can find a deal that you like and that you want to raise for. So by the end of week 4, you're going to be live collecting commits. The end of week 6, you could be raising capital for that deal, or at least prepping your investors while you decide on your next deal. And week 7 through 10, you're picking your next deal and you're going to lock it in and you're going to launch, because that's what we want. We want practical, active steps and people that take action. So at the end of the 10 weeks, this is what you walk away with: soft commitments collected, real investors, real indications of interest, tracked on our platform, a live investor portal, branded deal page, ready to accept commits, and ready to take on capital. And if we move forward to that phase 2, a fully formed SEC compliant fund of funds with the entity, the PPM, the bank account, all in 5 business days. And no matter what, a peer network of 30 serious capital raisers, accountability pods, lifetime alumni access. People are doing what you were doing, and who you can call and text and email and strategize with when you hit a snag or something comes up. So, and really important, direct relationships with these institutional lead sponsors. So for operators presenting their deals to you and helping educate you throughout the process as well. So you don't have to worry about cold intros. These are going to be real relationships that you keep and form and get and progress throughout your lifetime. And the ICA certification upon graduation, something to put on your LinkedIn, your website, your investor materials. And again, 10 weeks, but really you can launch in probably 6, which is what we really want for you. A live fund to fund and 4 bonus weeks for institutional deal presentations. So here's the deal. Show up, do the work. We guarantee the rest. Again, the 4 live deal presentations, the investor portal. Again, this would normally cost tons of money to get you set up and lots of time, but lifetime access to the ISC community, sponsor relationships, the full 10-week experience. And if we don't deliver, you get automatic admission to the next ISC accelerator. So we're going to keep doing this. The terms are simple. Just attend at least 80% of the sessions and complete the assignments. And that's the deal. And if you do that, and for whatever reason you aren't able to launch, we'll let you into the next cohort for free. So our reputation is on this. We're putting our reputation on the line, and we're betting on your success. So here's the value rundown. Real dollar values is what's here. The accelerator, 11 live sessions, $10,000 or so. You've seen people pay $10, $20, $30, $50,000 for this kind of stuff. Fund formation, if we get into phase 2, that can cost upwards of $25,000 or more. We used to charge $75,000 at DLA Piper, which is the firm I used to work at. It's absolutely insane. Deal page, investor portal, data room, $2,500 value. These relationships with the lead sponsors that are going to be built for you. Priceless, curated peer community for life. So you'll always be part of the school community that we're creating. $12,000 value. ICA certification. This is really special. An invitation to BEC 11, a VIP summit. So we'll have a special VIP event there. We're still working out the details on that, but we're certainly going to have an event just for you guys for the accelerator class, and possibly discounted tickets for BEC as well. So total value $50,000 plus, but at the end of the day, that's not what we're trying to get here. We're not in the we are in the education business, but we're not here to make money on that. Like, we're here to build infrastructure and to help people launch their capital raising business. We're not here to be marketers and to teach you all these things and then send you on your way and say good luck. Like, we're here to help you build. So this is what we're offering. The seat fee today is $2,500 to lock in your spot. But the big thing here is it's credited at launch. So we typically, as mentioned, charge $5,000 for that launch fee at Tribevest to do all of that laundry list of items that normally cost $25,000 or more. Well, your $2,500 that you commit today to get all of the curriculum that we just talked about will get credited when you get into that phase 2 and actually launch your fund of funds. So it'll just be an additional $2,500 to launch beyond that. So essentially what happens is you get to launch your fund of funds, and you get the curriculum, you get the 6-week, the 10-week program for free if you launch. So that's the big thing. Again, that traditional attorney route, this would be $25,000 plus, or if you're doing a community or a mastermind, they charge $10, $20, $50,000. You'll get all that for free if you launch the fund, because we just charge you what we normally would charge, and you get the program for free. So same price as Tribevest alone. Choice is obvious. If you're already going to set up a fund of funds with Tribevest anyways, the ISC is functionally free. So if you join the call and you're like, well, I'm already thinking about doing Tribevest and launching a fund of funds, well, join the ISC because you're going to get that for free anyways. So you just have to commit before June 1st. 2 ways to take action. You can do the $2,500 today. You can enroll, go to that link, and get going now and reserve that seat, because we're only going to do 30. We're going to cap it at 30. We want to keep it as a curated group. Or option 2, if you want to talk first and learn about more details and ask more questions that we might not get to today, book a call with my boy Cam, scan the QR code, and that'll go to his calendar, and he can get you all set up and answer any questions you might have. So the people who join tonight are the ones who show up at BEC 11 with the live fund, deal page, and institutional relationships. because that'll be big. Like this is a huge thing. We've been talking to Joe Fairless, Matt Faircloth about BC11. And it's gonna be huge. You're gonna get tons of value from this. We just need to flesh it out a little bit more before we talk too much about it. All right, on to questions, Rohan, if you want to jump in here.
Yeah, like we had a lot of questions, so I'm gonna try my best to do it. Yes, everyone, schedule a call. I apologize if the pricing slide was slightly confusing. The point for everyone watching this is that if you're gonna set up a fund, it's gonna cost you $5,000 with Tribevest. You might as well just join this because you're gonna get it for basically free on top of it. One question, Seth. If anyone is already in the process of setting up their fund of fund with Tribevest, should they still join this? What's your guidance?
In the process, absolutely. We'd love to have you.
Okay.
Absolutely.
Yeah, so I leave Mark. You put that. Yeah, just join. And the nice part is like, if you've already even paid the 5K for Travis, they may not even charge you. I'm not 100% sure, but
No, we wouldn't. If you've already paid and you're like in the process getting set up, you can just join ISC and it's free.
yeah, there you go. No, so that's a great thing. Let's see here. Apologies, I'm going to try to sort through all these messages. So, uh, Jay has a question: Is this is a Signal admin fund to fund, right? How does the like administration of the fund to fund work, Seth?
What was the first part, Rohan? Sorry.
Jay asked, this is a single admin fund of fund. So that's that. Is that true or
I think so. So it's a single asset. We'll call it that. Maybe that's what we meant. So it's a single asset fund to fund, meaning we call it an SPV. So a single purpose vehicle, meaning we form this SPV fund to fund, and it's designed only to invest in one predetermined target deal. So that's the syndication, that's the fund at the target deal level for these lead sponsors that we've been talking about. You set up your fund specifically for their deal to invest in their deal. And then when you do the next one, you'll do another one. So you just start stacking them one on top of the other.
yeah? Sorry, I'm just trying to sort through all your questions. Apologies, everyone. So in terms of that, that's actually a good question. With the operators that TriVest is built bringing into the ISC, what is like the due diligence process? Is there anything that TriVest is doing to help ISCs vet the operator? As everyone knows, one of the most important things in syndication is, who's the operator you're partnering with.
100%. So I do want to be clear. We have worked with these folks in the past. We consider them not only our partners, our friends in some cases, but you need to do your own due diligence. We are not going to say, it's 100% safe to invest with these particular sponsors. You have to do your own due diligence. And that is going to be part of the curriculum is how you can do that, what you need to do to properly vet a sponsor in a deal. And again, we'll teach you how to do that, but you'll have to make your own decision, based on your conversations with these lead sponsors, whether they're people that are part of this program or they're folks that you meet outside of it.
Yes, I think what was the point I was going to bring up? In this whole game of like syndications, raising capital, etc., one of the highest value skills is your ability to do due diligence on an operator on a deal. So in my opinion, if you want to do this business, long term, especially like it's a skill you should learn anyways. I think that Trivest does the opportunity of the people that are being brought as lead sponsors are very high quality. Trivest has worked with them for years and years, so there's definitely that level of reputation. At the same time, if you are going to become a capital raiser, you should become very good at doing due diligence because you're going to have to explain that to your investors anyway. So it's a very, critical skill you're going to have to learn anyways. All right, let's see here. I'm trying to think here. Yeah, exactly. Someone asked about foreign investors, correct. As long as the foreign investor sets up like a US based entity, then they can participate in this. And then Kate has a question set that I'm not 100% sure how to answer. Do you have to be an investment advisor to do this, or what's involved with being an exempt reporting advisor? I think this is where articulate how there's no like special certification you need to be a fund of funds manager. Is that correct, Seth, or just walk us through that?
That's correct. And different states have different laws. So you can't get into the weeds here. This can be its own separate presentation. TribeVest takes the position that you do not need to be an ERA, an exempt advisor. You certainly don't need to be an RIA, so you don't need to have a license to be an RIA. Because again, we're always trying to find exemptions and find our way around things like that. Like we don't want to be a broker dealer, we don't want to be an investment company, we don't want to be an RIA. Like we want to try to avoid those things because it just comes with a lot of red tape and compliance nightmares. So part of the reason that we do these SPV fund of funds, these single purpose vehicles that are designed only to invest in a single predetermined target deal is because of exactly what you're asking. It's so that you prevent yourself from advising, from crossing that line and giving investment advice and making decisions with investor capital. Because when we have an SPV, what we're doing is you're saying, hey, investor, do you want to invest in this deal or not? And the deal's already predetermined. Here it is. I'm not going to, on the other side of the coin, it would be like, let me raise some capital into this fund, and then I'll decide where I want to place it. Do I then want to place it in deal one, two, three, and four, one and three? You're not advising. The investor is actually making a decision whether or not they want to invest in this particular predetermined single deal.
Yeah, I think that's good. I'm just making sure. Yeah, Kate, this is where can I read more about the regs and the exempt reporting advisor? Kate, I would assume the best thing is just maybe schedule a call with our team. I'm sure they can walk you through that, or what do you think, Seth?
Yeah, that'd be great. That'd be
Yeah.
great. I would start it with Cam, and then we can go from there.
Yeah, I think because there's actually a couple more like slightly nuanced questions. My best thing, this is why, Cam is available for these calls. Like just hop on it, answer your questions. Let's get all the logistics, sorted through. That way you can get your fun to fun set up and ultimately join ISC. All right. Is there anything else? Anyone have any other questions about IC or anything that's like not super technical that otherwise you can go through Cam? All right, Seth, anything else? I think we yeah.
I was just looking at, I know we're past time. I know there's some
Yeah.
questions there that probably haven't been answered, but
Yeah, Steve, that's where, yeah, Steve, just please, Steve, just please, go ahead and use the link. If not, I'll have someone on our team reach out. Because, yeah, like I said, there's all these, specific questions that come up and these nuances where we can do it. So please schedule a call and let's get your questions answered. And if it's a yes, great. If it's a no, no worries either way. But there's no issue with scheduling a call. So please go ahead and do that.
yeah, I'm just looking at like accelerator questions. I mean, like Mark asks, please expand on the accelerator networking opportunities with other Tribevest capital raisers and who can help with this at Tribevest. Yeah, so this is the Accelerator One. This is our flagship first program. There'll be upwards of 30 folks involved in this. They're going to be a curated group, obviously. And, we have a vast network, though. Like we have almost 200 ICAs, I think, as well as dozens and dozens and dozens of lead sponsors in our pipeline. So once you kind of join the school program or the school network that we set up, you'll have access to, have conversations with each other. In a cohort, as well as when we have the next cohort, they'll join. You'll have access to Dylan Reach and maybe some of the other all-star capital raisers that we've produced, as well as the deal sponsors and some of those folks as well, to ask them questions and start practicing vetting them.
Yep, sounds good. Yeah, it sounds like a bunch you've already scheduled a call with Cam, which is amazing. So please, just I'm sure there's some final questions. So please talk to him, and he can get you going. Anything else, Seth? Any final words for our folks on here?
I think that's it. If you guys have any questions or anything like that, if you're ready to move forward, obviously, go ahead and go to the site and click through and make it happen. Again, if you're going to launch a fund of funds through Tribevest anyways, it's free. So why not join the ISC anyways? And then, if you're ready, if you still have some questions, book a call with Cam. Don't hesitate. He won't bite. He's an awesome dude. So go ahead and book that call.
All right. Thanks, everyone. The recording will go out in the next couple hours or tomorrow, and we'll catch you guys soon.
Thanks, y'all.